Pfizer, stock ticker PFE, is currently down over 37% in the past year alone, and year to date down around 1.77%. It's now trading pretty close to its 52-week low. Now we can see the company does have a very nice starting dividend yield, sitting at about 5.94%. So in this video, we need to look into all of the news that is currently surrounding Pfizer and ask ourselves the question by jumping into our stock valuation spreadsheet. Is Pfizer a stock we should consider adding to our portfolio? And like always, if you'd like to join a community of dividend investors and get access to any of my spreadsheets, you can head over to my Patreon page at the link in the description. But let's go ahead and start breaking down Pfizer stock. Again, there's a lot we need to touch on, but let's go ahead and start digging into these dividend metrics to see what we're working with. And like I already mentioned, nice starting dividend yield of around 6%. And if we look at the dividend history for this company, we can see it's a pretty decent history of increasing those dividend payouts over time, going from around 25 cents per share quarterly for this company to now sitting at 42 cents per share quarterly. So that's pretty decent growth over a 10-year period. Let's go ahead and look at those dividend growth rates. We can see the 3-year sitting at around 4.43%, the 5-year around 5%, and the 10-year dividend growth rate around 6%. So overall, that's somewhat decent dividend growth for this company. Let's go ahead and dig into the dividend safety. Now there's a lot to touch on with this company when it comes to the dividend safety tab. Now at first glance, look at this dividend payout ratio for the trailing 12 months with GAAP, which means generally accepted accounting principles. It's sitting close to 90%. Now obviously that is not a sustainable payout ratio, but really what we need to be looking at is the cash flow payout ratio, because dividends are paid out of free cash flow. And we can see forward looking to have a cash flow payout ratio sitting at 77.5%. So again, that is a very high cash flow payout ratio, and that means around 77.5% of the free cash flow this company produces is having to be used to pay out dividends. Now, for a company like Pfizer who seeks out strategic acquisitions and has a lot of research and development, obviously that is eating up a large chunk of their free cash flows. Let's go ahead and dig into the financial statement and look at the free cash flow history. If we click on cash flow for this company, scroll all the way down here to the bottom, we can see right here we have our free cash flow per share over the past decade. Now, if we take a glance at this, we can see we've seen a huge spike up in 2021 and 2022. Now, if you know anything about this company, you know exactly why this was. This was due to the huge increase in revenue due to the COVID vaccine. So while this was a great spike up in the free cash flow for this company, obviously this is not sustainable. And in fact, we can see 2022 free cash flow per share came in at around $4.64, but for the trailing 12 months, it's sitting at just $1.45. So let's take a step back, go back to the summary tab. We can see here the forward-looking dividend rate sitting at $1.68. That means for the company to be able to pay out that dividend out of free cash flow, they need to have a free cash flow per share of at least $1.68. So when we jump back over to that cash flow statement, scroll back down to the bottom and look at the free cash flow per share, we can see for the trailing 12 months, they did not have enough free cash flow to cover that dividend payment. Now, obviously, that is a huge red flag. So the question is, will they generate enough free cash flow moving forward to be able to continue paying out that dividend and hopefully get enough free cash flow to grow that dividend over time? So let's go ahead and jump into some more reports on Pfizer. Now, the first thing we need to look at is what has their growth look like outside of the COVID product. Obviously, revenue from COVID products have decreased dramatically over the past year or so, but here's the good news for Pfizer. Excluding COVID products, Pfizer said revenue for the quarter grew around 10% operationally. So again, that's pretty good news for someone if you're interested in Pfizer stock or if you are a shareholder. Let's go ahead and look at the earnings per share history for this company. If we go over to the income statement and scroll down to the bottom, we should be able to see the earnings per share. And again, it's kind of the same story. It's bumped up and down a little bit over the past decade, but in 2021 and 2022, there was a huge spike up in earnings per share due to COVID products. But again, if we look at the trailing 12 months, it is drastically lower than 2022 and 2021. And in fact, it's reverting pretty close to where the mean has been over the past decade. Now, while we're looking at the income statement, something I do want to point out is look here at the weighted average shares outstanding. We can see it's decreasing over time, meaning that Pfizer is actively buying back stock. And this is one of the 5 ways that companies can use their free cash flow to reward shareholders. And this essentially gives shareholders a larger ownership portion of the stock. So again, that's pretty positive news. So the goal for Pfizer is pretty clear. They have to find a way to grow earnings and free cash flow per share without being reliant on COVID products. And if we jump into the investor's presentation, one of the ways that they are seeking out to do that is through acquisitions. And we can see they recently have a new acquisition with Seagen. And if we look at the strategic rationale here, we can see the basic premise is there is a large and growing amount of adults in the United States who do struggle with cancer. And if we scroll down here to the next slide, we can see basically what they think. Pfizer's capabilities combined with Seagen's targeted technology give us the opportunity to develop powerful new medicines and give hope to cancer patients everywhere. So with a company like Pfizer or a company like Johnson & Johnson, we need to constantly be looking at what is in the pipeline for this company, because that is where the growth is going to come from. And we can see with this strategic acquisition, this is going to bring about 4 new products for Pfizer, and here they are right here, and this acquisition doubles the size of Pfizer's oncology pipeline and late-stage development program, and oncology pipelines are known to be fairly profitable. Now my concern is even with the strategic acquisition we're seeing from Pfizer, I still think they have a very long way to go to see decent growth rates with their earnings per share and their free cash flow per share. So that being said, I don't necessarily think the dividend is at risk right this very moment, but over a long period of time, we'll see very slow dividend growth rates, and essentially if they can't get higher earnings growth rates, we will eventually see a dividend cut. And again, with all of that being said, Pfizer could still be undervalued. So let's go ahead and jump into my stock valuation spreadsheet. Again, you can download the spreadsheet on my Patreon page. Let's go ahead and jump over to my stock screener and plug in stock ticker PFE and hit enter, and you can see all of this data will automatically load in. Obviously, 365-day chart, not something you want to see. Analysts have a target price of around $31.37, institutional ownership around 70%, and a beta of just 0.59, so you should see low levels of volatility with this company. Now, the 2 main valuations that I really want to focus on in this scenario are going to be the discounted cash flow and the dividend discount model. But let's go ahead and glance at Graham's valuation as well. If we go ahead and zoom in here a little bit, this is basically a way to value a company based on the earnings growth projection. And if we actually jump back over to our investors presentation and scroll down a couple of slides, there's something I want to point out. We can essentially see here our 2024 financial guidance for this company. We can see the 2023 reported revenue guidance right here and the 2024 financial guidance. They're essentially saying there's going to be very little to no revenue growth, but if we come down here and look at adjusted diluted earnings per share, we can see they are expecting some growth in this area. So let's jump back over to my valuation spreadsheet and take this into account. We'll go with an average estimate of earnings per share of about 2.15. I'll be a little more aggressive than I usually am with a growth rate projection of 5. And with Y, the current yield on AAA corporate bonds coming in at 4.93, we can still, even with a little bit more of an aggressive growth rate projection, we still come to an intrinsic value of $23.03, which is still a little bit below that current trading price. But again, we're not going to use it in this scenario. I think the DCF model and the dividend discount model are by far the best valuations for Pfizer in this scenario. So let's go ahead and jump over to our DCF model here. And again, we're trying to value the company based on how much future free cash flow they're going to produce. So to predict that, we need to project a growth rate to the future free cash flows. And one of the things I've done is plugged in the historical free cash flow, and historically we have an average growth rate of around 4.75%. Now, like we saw earlier, the free cash flow has been all over the place, especially with the huge spikes up in 2021 and 2022 with their COVID products. So even if we produce a 6% growth rate for the future free cash flows for this company, add in the cash and subtract out their debt and divide by shares outstanding, we come to a discounted cash flow price per share of $30.66. Now again, the big question is, can they produce a free cash flow growth rate of 6%? I think it's possible, but it's not going to be easy for the company to do. Now the last valuation we'll look at is the dividend discount model, and basically what we're doing is valuing the company based on how much they pay out in dividends and how much those dividend payouts are increasing over time. And like we already saw, unless they can increase their free cash flow, the dividend growth rates will slow down dramatically. So in this scenario, I'm projecting a dividend growth rate of 2.75%, discount rate of 8%, and that gives us a dividend discount model price per share of around $32.88. So when we jump over to the output tab, we can see when we average these two valuations together, we come to an intrinsic value of $31.77. So with a 10% margin of safety, it does look like it's in our acceptable buy range, and a 20% margin of safety, it's a little bit outside of our acceptable buy range of around $25.42. But again, let me be perfectly clear. The path to revenue, earnings, and free cash flow growth for this company is not very clear, and it's definitely not guaranteed. If Pfizer struggles to grow their free cash flow, then those dividend payments are definitely at risk. And so while that dividend yield of around 6% definitely looks juicy right now, keep in mind that is a fairly risky dividend. And I think this is a great example of a company that Warren Buffett would call a cigar buff company. Maybe it's a little bit undervalued, and if you buy in, you might see it revert back closer to its intrinsic value, but over the long term, I think your money is better off in other places. The opportunity cost of investing into this company rather than other stocks is probably a little bit too high for my liking. But there you go, there is a quick analysis on Pfizer stock. Go ahead and let me know what you think of this company in the comments down below, and like always, if you'd like to join a community of dividend investors and get access to any of my spreadsheets, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.